Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, February 15th. Hope you guys had a wonderful Valentine's Day yesterday. We're going to just jump right into it. We got a lot of data to go over today, as we had mentioned earlier in the week, that most of the stuff was from Wednesday on. Yesterday being the big day for inflation data on the CPI report, and we had retail sales. But today we got a long list of items, and tomorrow will be a pretty big list as well. More home related stuff tomorrow, like permits and such tomorrow. So we'll kind of get into that. But today, we'll start off with the weekly jobless claims we get. As you can see, last week had a really low number at 223,000 people applying for unemployment. For this week, the forecast is 230,000, and it came in at 230,000. So it's just a $7,000 uptick. But these are, again, you got to keep into consideration, these are multi-decades lows. We're talking about from 1973. These are the best numbers we've seen. This is kind of leading into some concerns actually from small businesses as they found in the reports their confidence level, and also other employers that the labor market is tightening up a bit, and it's concerning because they're wondering where they're going to find employees. They can't really go out there, so they're paying their people more to retain them. In essence, and which we're seeing a little bit higher inflation in terms of wages going up. Now we are a little ways away. The market is reacting negatively about any types of inflation, but we're hearing from a lot of Fed members that we're a long ways away from wage inflation being that dramatically to affect overall inflation. But again, we're on the upturn as to where things are moving. So let's kind of continue this. We got the Empire State Index. So we got the next two here are going to be manufacturing data. So this is manufacturing in the New York region. So here we see 17.7 in the month of January. It dropped to 13.1. However, in the Philly region, we had a 22.2. Philadelphia region. This is by the Philly Fed. We had a 22.2 in January, and it went up 25.8. So New York went down a little bit in manufacturing, whereas Philadelphia went up. Now, the last time around, it was actually the opposite, where Philly went down and New York went up. So, again, we're going to have range where they're going to go up and down, but still, again, decent numbers here. Now, we got core PPI. This is an inflation number, but on the wholesale side of things. January, it dropped 0.1%, and in February, it did jump up quite a bit at 0.4%. Now, both the headline number and the core came in at the same number of 0.4%. We have a 2.2 year-over-year rating on there. So this could show some signs of possible inflation. Now, we don't put a lot of weight into the wholesale side of things, primarily because there's so much competition on the wholesale side of things that their increase, or they may kind of mix up their margins a little bit, may alter the margins to may accept less margins when it gets passed on to the consumer. So what we're really looking at, and the Fed looks at, is what is passed on to the consumer overall. Again, wholesale side of things, they may lessen their margins just to be able to keep up with competition in order to go. So that's why it doesn't have as much weight. But it does give us some indication as to where the costs are going, if they're going up or not, down. So industrial, next one on the docket is industrial production for the month of January. So December had a pretty big uptick of 0.9%. January's forecast was supposed to slow down a little bit to 0.3%, and it actually dropped 0.1%. Capacity utilization for the month of January. So December we had a 77.7% on the utilization. It was supposed to have a slight uptick to 78, and it had a slight, almost unchanged, to 77.5 in the month of January. Now we got the NHAB Home Builders Index. This is a gauge as to the home builders, their confidence level survey, basically, that came out for them. See where their feelings are, and it came in at the same. It was unchanged for them, January to 72. They are feeling pretty confident. Future sales in the report were showing really strong. Again, we're kind of needing these guys as we don't have much inventory out there, so we're needing new homes to be built. So if anything, we really need them building new homes, as again, inventories are at all-time low of about I think it was 3.2 months on a national average inventory level. So let's kind of jump ahead here. So far, the stock market is doing quite well. It's up so far this morning. It's kind of rebounding nicely from a pretty rough last week here, as we saw, a couple of days where we had minus 1,000 in the Dow. So that's pretty incredible. So right now, it's kind of rebounding a little bit. It did shake off a little bit of the inflation news on there. Again, it's kind of what they're showing. What they're thinking is that the economy is going up, is stronger. It's improving, but not quite yet in the immediate term heating up, overheating, so to speak. So uh, because it's not, the thought process is it may be overheating, so therefore the Fed may not be as aggressive on their rate hikes. But they are going to, of course, keep a close eye on that inflation level uh, because the difference between last year and this year is we got a few more hawkish members, including the Jerome Powell is a bit more hawkish, where Janet Yellen was a little bit more of a dove in terms of rate hikes, in terms of our policies. So when you have somebody who is more hawkish, that means they're going to be more inclined to be more aggressive in rate hikes, and that could lead to a slowdown in the economy and then perhaps a recession. So that's why there's a bit of a concern in terms of inflation here. So let's kind of jump ahead here to the bond market. We are currently we changed over bond to the 4% coupon. So we're not, before we were on the 3.5% coupon. Now we're kind of switching over the coupon here. And currently we're up about 13 basis points. As you can see, we did start off slightly lower, but we are up about 13 basis points, which translates to a bit of a more improvement in our pricing today. So pricing should be a little bit better than what we left off yesterday. We did have pricing for the worst yesterday, as it dropped. It was down about 50 some basis points, and it closed up down 42 basis points for the day. So, but today so far we are up about 13 basis points. As you can see, we have this downward trend right here. It's possible we could come up. We're on the lower part of this downward trend, but we have room here to come up and improve a little bit here. So, I don't know if we'll get it today, but it's possible we could get it tomorrow, especially when we got kind of a long weekend going ahead here. Monday will be President's Day, so we won't really have, the market will be closed on Monday, so you won't be seeing us on Monday. All right, so let's jump ahead to the Treasuries. The Treasuries are down. Here's this important threshold here where we talked about the resistance here. Yesterday we closed above it at 2.91, whereas today we did test it, and right now we're down to about 2.89, which is a good sign for us. As you can see, Monday we had that above 2.9. We tested it again yesterday. And we want to try to keep that below that resistance level, because if it goes above this, it could easily go up to about 3.04%, and which would only push rates that much further down. So with the higher yields. All right, and also that could affect the stock market a bit as it's reaching higher yields. Again, a lot of investors may take the money out of the stock market and put it into less risky assets such as bonds. All right, so that pretty much wraps everything up. If you guys want more data, just come over to Twitter. You can find me at Mike Bjork. I post throughout the day there. I hope you guys have a great rest of your day. We'll look forward to see you guys tomorrow. Thanks again. Bye-bye.